Hey, it's Joshua Kittle, and in this episode of Mortgage Clarity, we're going to talk about credit scores and how USDA looks at credit score. So we're going to talk about what's the minimum score requirement the USDA requires, what validates a credit score, what happens if you have things like bankruptcies and foreclosures, disputed accounts or collections. How does USDA look at all these things, and how's that going to impact your ability to qualify? So let's go ahead and jump into this. If you've got questions, feel free to message me directly. If you find this video helpful, be sure you like it and share so we can get the word out. Now, when we talk about all these programs, it's really important to remember that we're talking about the requirements set forth by USDA as the minimum requirement that all lenders must meet. However, every lender has the ability and the right to add additional, what we call overlays or restrictions. So while USDA does not have a written credit requirement for a certain score, your lender definitely might have a minimum requirement. And some of these other things we'll talk about, like USDA and what happens if you have no credit score. Do you do can you get a USDA with no credit score? Again, just keep in mind that the lender you're working with may not allow for those. So, and the reason for that is, again, ultimately USDA, they're not the one lending the money. It's the lender who you're working with that's lending the money. It's the open market that's going to purchase it. Essentially, what these programs are doing, like USDA and FHA, is they're stating that if this program or this file meets this minimum requirements and gets the funding approval from USDA, then should the borrower ever default on the loan, there'd be some recourse or some insurance for the lender to get partial restitution for their loss on the loan. So that's what's going on there. Okay, so let's talk about credit score. So as I mentioned, no, USDA does not have a written credit score that says you have to have this score. However, it does basically state that the lender, if you don't have a certain score requirement, then the lender is going to have to document some other items in the file. Or if the score drops too low, then if the lender allows for manual underwriting, you'll have to do a manual underwriting. With USDA, 680 is kind of the top tier. Really, if you have over a 680 credit score and the score is validated, and we'll talk about what makes a validated score here in just a moment, then the lender really can just accept it. They don't have to go in and document anything around the score. As the score drops lower, so 680 to 660, 660 to 640, 640, and so on and so forth, the lender, if they're going to make that loan, is going to have to do some additional things to basically support that the borrower in question is credit worthy. And so, again, over 680, they just don't have to worry about it. Less than 680, they'll have to start to document it. And they'll do this with things like letter of explanations as to what caused the credit to get past that. Payment shock, if the borrower currently has a rent payment of $1,800 and they're going to get a mortgage at $2,000, that payment shock's less than 15%. That could be a compensating factor. So there's lots of different things, but the thing is, as the score goes lower, the lender has the responsibility to be able to substantiate in their file while, in spite of the lower credit score, it's still a good loan to make. So now, to validate a score, it's not just about having a credit score. You have to have an acceptable credit depth or credit history. Now, we'll do other videos here to talk about what causes credit scores and all kind of good stuff. But in short, in this video, USDA says that if the borrower doesn't have at least 2 trade lines that's been open for at least 2 months, or not 2 months, 12 months, then it's not a valid score. And the lender can't basically use that score as its credit decision. And it does needs at least one borrower with the valid credit score in order to get the automated approval and not be downgraded to a manual underwrite. So that's where credit score comes into. So now, again, examples of trade lines would be like credit card payments open for 12 months, car loans and stuff like that. Now, sometimes we'll have a client that will have an authorized user account. So it'll shows up, they have 2 trade lines, but if you look closely, it will note that the one trade line actually isn't theirs. It was a credit that was open and granted to somebody else, and they're just an authorized user. And as an authorized user, it did come onto the score. So that does help give them the score. But again, if that's the only trade line they have, or it's one of the 2, then that's going to get excluded unless there's 3 situations in which the lender could then go ahead and use it. One would be if that authorized user account belongs to the spouse, then they could consider that to still be validating the credit score. If the person for whom the authorized user account belongs to is not a spouse but on the loan, you can use it there. Or if the person who owns that account is not on the loan, they're not a spouse, but the person who's getting the loan is the one that makes the payment and can support 12-month payment history, then you can use it there. Okay, so that's credit score. So top tier 680. I would think you'll find most lenders probably want a 640 or higher. I've seen some conservative ones want 660. But again, it's really going to be based on the overall profile. When you run it through the automated underwriting system, will USDA's automated system say the file is acceptable as is? If it is acceptable as is and the score is below 680, the lender just has to document a few extra things and you can go. As you get lower credit scores, what you'll find though is while it doesn't have a written requirement, the score drops too low and the automated underwriting system for USDA is not going to give that lender that approval, and it's going to be considered a refer with caution. Most lenders will not do a loan with the refer caution or manual underwrite requirement. So you would want to check into that. But just because you get a refer with caution doesn't necessarily mean the lender has to decline the file. If they want to take some additional steps and they can document some circumstances behind that, they can choose to do so. So that's credit scores. We talked about trade lines, what makes a good credit score. So let's talk about what happens if you have no credit. Can you still get a loan with USDA if you have no credit? Again, yes, it's possible. It's called non-traditional credit. The lender you're working with has to be one that agrees to do so. And essentially what they do here is a lender is going to find other types of payment history that don't typically report to credit bureaus and then get documentation to prove that you're making that. So most common is going to be your rental history. So if you have no credit history, your file's blank. Now, if you have no score, but your credit report shows negative past history, then this isn't going to work. But if you basically have a score but not sufficient trade lines to document that score, then you can do non-traditional. Or if you have no score and nothing reported in the report, you can do non-traditional if the lender allows. And what they're going to look at is things like your rental history. Is the lease in your name, and can you show you've been making the payment for the last 12 months on time? That's the one they really want to see. But if you don't have that, then they can look at some different things like phone bills. Do you have a phone in your name that you've been making payment for? Electric bill, car insurance. There's quite a few different things, utility bills that a lender can use. They can't use things like child support, spousal support that's required to be paid, or garnishments. Those don't count as credit history, and neither do things like memberships, like Book of the Club month or Wine of the Month Club or a gym membership. Even though you've been doing this for 12 months, they would not consider that as payment history. So that's non-traditional. So what about disputed accounts? This comes up quite a bit. So if you have accounts that are in dispute, how does the lender look at that? For the most part, the lender is probably going to require you to get that disputed account removed. And the reason for that is if you have let's say a trade line and you've been having major payments on it for like 3 or 4 times in the last 12 months, if you dispute that, then that gets removed from the credit score factor, which means we don't really have a real credit score, because as long as that's in dispute, if you're honestly liable for those late payments, then that needs to be calculated into the credit score to get risk assessment. So for most cases, if you have an account in dispute, they're going to ask that to be removed. Now, exceptions to that would be in cases where accounts are disputed, the balances are 0, and the late payment activity happened more than 2 years ago. If that's the case, then a lender can say, okay, we don't have to remove that dispute. But again, if you have a late payment history where 18 months ago you had several late payments, you got upset with like the phone company, and so you just disputed it, that's going to have to get resolved because it's within that time frame. So collections. Now there's a couple different types of collections, and the way USDA is going to look at that is going to be a little different. So I'll start with the big one that we see a lot, medical collections. Now the good thing about medical collections is the lender does not have to penalize you for that. It does get factored into your credit score. So having medical collections on your report, depending on how it's reporting, could be lowering that score, which could have an impact on whether or not you get that automated approval, what the interest rate's going to be, what the max house you can qualify for. So it can impact you from that standpoint. But the lender's not going to be required on medical bills to actually require you to pay those off or go into a repayment program, or to calculate some type of payment on that debt and actually impact your debt ratios, lowering that purchase price. So those can be excluded. Other collections, though, may have to be taken into account. If your total collections are less than $2,000 and the collection accounts, aged over 24 months, then typically we can just ignore those collections and they don't have to get paid. However, if it's within 24 months it just went into collection, or your total collections exceeded $2,000, then you'll either have to go into a repayment program with the person collection and then let the lender know what that payment is so they can factor that in, or pay it off in full at closing or before closing, or the lender can choose to take 5% of that balance and just hit you for that payment and then move forward that way. Last thing I want to talk about really quick then is going to be what we call significant derogatory items. These would be things like bankruptcies, foreclosures. How does this impact your ability to get a USDA loan? Most of these types of significant derogatory items require a minimum of 36 months from the completion of the event. So most common we'll see is the Chapter 7 bankruptcy. You go into the Chapter 7, once it's finalized, the court records it, that date starts the mandatory 36-month waiting period. As long as your loan closes after that 36-day month up to the day, then you can actually move forward with this traditional normal underwriting based like on any other file that did not have that event. Now with the Chapter 13, this is a bankruptcy where you actually go into a repayment program. And in this one here, it can actually be as little as 12 months out. So on a Chapter 13, you actually negotiate with the court, you enter into a repayment program. Once that's been finalized and approved by the court, after you have a 12-month history of making your payments as required, and you cannot prepay this, so it has to be a full 12 months, make your payments on time, then with court approval, you can qualify for a USDA loan. Now it's going to be a manually underwritten loan at this point, which means those debt to income ratios will be held to the lower standard. So it will limit that max purchase price compared to not having that manual requirement. After you've completed your Chapter 13, then from that point forward for the next 3 years, you don't need the court approval because you're done, but you're still limited to that manual underwriting debt ratio number of like 29% for the house payment and like 43% for the total debt ratio. After 3 years though, then that's waived and it's just standard underwriting on a USDA loan. So I hope you found this information helpful. Again, we went through a lot. In summary, no, there's not a minimum USDA score requirement. I think you'll find though, when you get below 640, it gets difficult to get that automated approval. You'll find that most lenders won't do the manual underwriting. Just because you have things like collections or medical debts does not mean you're not eligible for USDA loans. So again, one of the best things I can say in this video and all my videos is, you're not the expert, so don't disqualify yourself from a loan program because you think you have to have perfect credit. You get a lot of this kind of negative information in the news where it's, oh, you have to have perfect credit or you won't get a loan. It's not true. So before you kind of write yourself out of the benefit of homeownership and thinking you can't get a loan, talk to a qualified lender, give them all the details, let them find out what the options are. You might be pleasantly surprised and realize that you do qualify for the program that works best for you. All right, until next time, have a great day.